Yeah, I'm losing my
So we're selling
edge.
stocks, Pete, in a small manner. Yeah, this is going to be a fun little segment that is apt. It's
It
very
is
relevant
apt. It
today.
is a classic case of staying small. Yeah.
It was relevant yesterday, Pete. It was relevant last week, the week before, last year. Selling stocks is a situation, a strategy here, a better word for it, that is relevant. And this is just the nature of markets, where you've got, from a day-to-day basis, equities move higher. You expect the 50-50 higher versus lower, as we see in more traditional asset classes like energies and interest rates and stuff like that. But we've seen through years and years of research, positive drift in equities on the day-to-day basis. And then, Pete, when you're looking at longer term basis as well, and this is why people build core portfolios, long-term positions that are long stocks, you see the fact that over a large enough time frame, equities push higher, probably more like 70% of the time or 80% of the time. And so how do we look at short-term opportunities at these highs if we want to be contrarian, we want to get on the other side of these stock moves? Because the stock market does move lower here and there in the short term, and inevitably you do see a big crash lower every couple of months or years. And so it's a matter of staying small while waiting for that moment. And that's what we're going to go through today in the exercise, because a lot of people, Pete, look at a stock market like this and you're like, wow, it's got to move lower from 2010 until now. I mean, that's 400% growth in the S&P 500 index here. And you saw that what I would actually contend is a crash early last year. Now, it was there for all of 2 or 3 weeks, but you had this market, most equity markets, Pete, being cut by about 30 to 40%. And so that, to me, that's a crash. I know that a lot of people have gotten into this game of like, well, what is a correction? What is a crash? And naming all these things in different ways. What we're basically looking for when we're selling stocks, Pete, if you're looking for it on the day-to-day basis, is like 1 or 2% lower. That's a good place to take some profits.
Right.
If you're looking at with a little bit longer time horizon, then maybe you are looking for that 10, 15, even 20%. But Pete, as you can see here, if you're picking any spot on this chart from I can't believe that it was as recent as the early 2010s that S&Ps were in the 1,000 handle. And now they're closing in on 4,000. You got to stay small, especially if you're looking for that big crash, because it takes a long time to get there.
Absolutely. And I think this is, it certainly is, amalgam of a lot of different things, cheap money, innovation, whatever you want to attach to it. But yes, the pace of movement is dramatic by any standard, going back to a 10-year slice of growth. So, I mean, for me, I look at this and it's like, we don't cherry pick a chart to make a point, but here's a classic case of, affording yourself reasonable mechanics around a trade is certainly very powerful, and especially with a product like, and I'm curious, Frank, because you mentioned this, we always talk about positive drift in stocks. The structure of them, the nature of ownership is much easier to own than it is to sell. How much do you assign? Do you assign a linear, in other words, if S&Ps were at 2,000, I assign that drift was 1.5% of the growth that year. Now we're at 3,000, maybe it's 3%. Do you look at drift or that upward bias in a linear fashion, or does it really not figure in to your day-to-day or even week-to-week trading? I'm curious to hear your answer.
Well, that's an interesting thing, because my brain is so weird and messed up that I do think about things a little bit like you're getting at, which is, S&Ps at 3,900 or small stock 75 at $69, climbing all the way from lows of last year in the 30 handle. I do look at things as like a percentage chance between getting to infinity and getting to another crash. And by that, I do mean like, oh, they've inched higher via this drift. And so that's the market just pricing in the fact that everything is optimistic, and there's a greater perceived chance of this market just moving higher to infinity, because and infinity is a funny thing. I wrote about it a little bit for the Small Exchange newsletter, because it is like when you're selling stocks or selling calls or anything like that, it is the theoretical bound of this market in the same way that zero is the theoretical bound when you're buying things or selling puts. So, I mean, drift factors into it for me, but I always look at like, for instance, we've seen a lot of like 100 to 200 point rallies in NASDAQ recently. And to me, that's always like almost like inching closer to just like the most bullish, like good feeling stock market we can get, similar to Fed funds rates, inching
Right.
either closer to 0% or closer to 25 basis points or 50 basis points. And those futures are pricing in that theoretical probability that, a more hawkish Fed is coming or a more dovish. And I know this is, become a very long aside here, but yeah, no, I think that the positive drift at the end of the day is not something that I want to sell into. When I'm trying to sell stocks or get on the other side of an all-time high in a market, I'm trying to do that in a manner where the market has put in its positive drift here and then it's extended on it. That's the difference there where I see the opportunity, Pete. Not the positive drift is I think taken for granted in my strategizing when selling stocks. Like it's almost
Yeah.
like you have to, like stocks being up on a daily basis, like zero point 0.1 or 0.2%. That's not interesting to sell. But when they expand through that positive drift and they're up 1.5% or 2% or 5% in any given week, or like we saw last year, 30%, that's reaching beyond that positive drift, where I think that's where the opportunity is coming back to it.
Interesting. That's an interesting, because honestly, for me, it never figures into the equation. I don't look
Okay.
at, the market's up 2% and there should be over the next 6 months another 1.5% of drift. It's interesting to see how you kind of wrap it into your
Well, on a
thinking.
daily basis, I'm glad that you bring it up like that, because, yeah, on a daily basis, for the purposes of today's segment and us active traders looking to sell stocks, that positive drift, it doesn't have any place in it, right? Because, yeah, like if you were to say equities move higher by 7% annually and you bring that down to a 1 day move, it's a fraction of a percent. And so at that point, it's a rounding error. And yeah, like you're saying, NASDAQ up 2% or SM75 up 3%, some of the
Right.
moves we've been seeing, that positive drift doesn't even matter at that point, right?
No, and that's it. I think 6 months on a position is an awfully long time for me. And the only thing I can tell you is that within that 6 months, my bias may be consistent, but my activity around that bias, I will be in, out, long, and short many times. So
So let's get on to employing that bias, though, a little bit. And I left this blank because I was supposed to ask you during the break, but I forgot to it. So we'll do it during the segment itself. Why you would look at using futures versus stocks, Pete, to employ a short strategy, especially a short-term short strategy, like we're talking about, not factoring in this long-term drift where it's like, and it's something that just popped into my head, something that you and I kind of make fun of a lot, where it's like, oh, the Bank of America research desk put in a price target of
that's
39.26
got to
in,
be the worst
yeah,
job in the world, because they hold a figurative gun, as some economists said, and say, all right, tell me where the price of crude is going to be in the end of the
sure.
year. I don't know how anybody can even sit there and
And
attempt to make a guess. So, I mean, when we look at the advantages, you have two of the important ones: capital efficiency, no pattern day trading rules, which is so important.
yeah,
You get spoiled trading futures to an extent. And when you go back to, if you're under that $25,000 threshold, that inability to trade both sides of the market. And that is incredibly difficult. The neutral nature of futures, the ease at which you can sell and buy, is an incredibly powerful thing that you employ all the time, but I don't want to say take for granted, but it just comes with it, which is a great thing. And also the idea of, sure, you could trade SPY, which is a basket, but the ease at trading a diversified set of underlines is critically important for me. So those are, some of them. I got out. Sorry about the dogs.
No, you're good. The dogs are getting excited here about these advantages as well. And yeah,
Today is your day for watching the dogs. I don't know why you didn't pick them up.
And these are all good tie-ins to why we don't, look for that Bank of America or Merrill Lynch research desk number, because we're looking for opportunities in the short term. It's not like, okay, S&Ps have hit 39.26, so now I'm selling. It's a matter of like, wow, this looks like too big of a move to the upside. I want to make some money in the intraday, in the short term here, and all of these things leading to futures over stocks. And a lot of people, as recent as 2 weeks ago, seeing a lot of the problems with trading stocks, the single names there, intraday, very problematic, as opposed to futures where we don't see a lot of those problems. So now I want to get into the fun portion of our conversation here, because even with the SM75, a small equity index futures market, it's still pretty big. You're seeing a climb from the last year's low to where we rest currently of $3,000 to $7,000. And it's the same percentage basis as your, S&P ETFs and everything else down the line. So it's nothing abnormal here, but you are getting that capital efficiency on a product that can move a lot. Like, for instance, the SM75 futures are about $500 to trade a contract. And as you can see here, this market has climbed multiple bouts of $500 in just the last year. So it's a matter of bringing this down to a smaller trade, Pete, that I can manage on a minute by minute basis. And if I'm choosing to deploy the strategy a little bit longer, for a day-to-day or even week-to-week basis, because this is, even for the small exchange, Pete, this is a large move. And then you look at even the micro E-mini NASDAQ and S&Ps, or those E-minis themselves, and they're 4 to 30 times this move.
Yeah, and it was so funny because I was looking at this exact same chart this morning and just really looking at, sounds so silly, but I was really looking at just with, the exceptional nature of going from 3,000 to 7,000. And I remember us 2 years ago building product and deciding, well, you know what, is 3,500 too much to build this, to build the smalls out at, the small 75. So we, the exponential nature of such a short amount of time moving like this has really been something else. So, the trading opportunity back and forth here is so important. The mechanics we always reinforce, and I know we beat this, but every day it's another example of maintaining a ability to, certainly, I don't think Frank and I are looking to sell puts if we had them, or buy futures up here, but be able to reasonably trade both sides of the new range. Anywhere along. Go ahead.
Well, we're definitely looking to add those short puts to the position to get this thing a little bit smaller, because it's funny, we're talking at the small exchange about adding what we've been talking for a while. It's just a matter of the best way to do this, to add crypto products, Pete. And it's this matter of what size do you want to make it that fits the retail trader, but also allows for movement. And what's nice, since you have so many equity products here, Pete, that you can append little things here to, for instance, going from the last chart to this chart, you can see that y-axis reduced the movement from about $4,000 low to high to about $2,000 low to high by just adding 15 deltas or 15 shares in IWM. And we talk about this all the time. We usually jump into, we're going to look at short SM75 futures and a short put spread in IWM, and we're looking for 10 to 20 deltas. And that's what this is here. But I just wanted to show people why we're doing this and what it gets you. It gets you this smaller trade here, Pete, and which, like you like to hammer home very often, gives you greater time in the trade, which is essential.
Right. Absolutely. And, I think, and again, great example of a market that a lot of times pairs trades will show you in a flatter market a little bit more back and forth. That's one of the reasons we like them. The other reason we like them is what you mentioned specifically is time. And what I mean by time is the market to trade around a certain level in terms of P and L, profit or loss, that you're comfortable sitting in until your strategy unfolds. So it's really, you look at that movement, it's very similar to what we just looked at. And that's why we use correlated underlyings to do pairs trading. But look at the difference we've had in the amount of nominal or notional movement. Slowing this down in a very simple fashion affords you so many benefits. And the mixture of products, we're not a smalls or guys. We're smalls and guys. And this is a great example of pairing this with an existing product that really maximizes the use of the futures.
Absolutely. And it's really, to me, jumping from one chart to the other. It's almost the same trade here, but it's a matter of, if you got short into this most recent up move where we saw a reversal and then a bounce back, am I willing to hold through right here this last week or so, about $500-600 worth of movement relative to $200 worth of movement? It's just getting yourself a little bit more comfortable. And then the fullest extent of this is what Pete alluded to, which is a full-on pairs trade. Because if you add enough long deltas or shares there, Pete, you can hedge 100% of that short. Now you've got the smallest y-axis here in the last. This is kind of crazy. In the last year of trading, the equity market itself in SM75 has a high to low move of, I believe it was $4,000. When you hedge this thing and look at the pairs opportunity, that high to low move here is under a single $1,000. And so this is just all the different ways of getting smaller while being short an equity index future like the SM75.